Hi there, and welcome to this video where I will explain a super simple trading strategy that might be beneficial for you. You can use this as a simple baseline to build further trading rules on to further enhance your chances of making profits in the markets. So let's see what this simple trading strategy entails. This strategy is supposed to be used without any indicator, although it is wise to use one to distinguish between bullish and bearish circumstances, and for that I will use the EMA 50. The premise behind this strategy is that in bullish markets there are more green candles that follow each other, and after entering a trade after the first green candle, more will follow. Eventually this should result in trading profits because you ride the trend. Once a red bearish candle appears that has a certain condition, or two red candles follow each other, the trade will be exited. You can also reverse this strategy under bearish circumstances and enter a trade on the first red candle, expecting that more will follow and will result in a winning trade. Once a green candle appears with a certain condition or multiple green candles follow each other, then the trade will be exited again. In short, you assume that under certain conditions the same type of candle follows each other after the first one appears, and if there is a trend break, you exit the trade. So again, for this specific test, the rules are super simple. In bullish trades where the price exists above the EMA 50, the entry signal is the green candle close. The exit signal is the first red candle that closes below the half of the last green candle. And I also have a second exit signal that closes the trade after two red candles, where the idea is that the momentum is getting weaker. In bearish trades, so everything below the EMA 50, the entry signal is the first red candle that appears and the exit signal is the first green candle that closes above the half of the last red candle. A second exit signal is when there are two green candles following each other. Now I will not say that this is the most ideal trading strategy because you are gambling on the assumption that same candle types will follow. Therefore the exit signals are also pretty risk averse too, to prevent unnecessary losses. If you are a regular viewer of this channel, then you know by now that my way of backtesting a trading strategy is to code this into a Python algorithm that can be used by a backtesting engine. And this way I can produce fast backtests over large amounts of data and on multiple trading pairs. This way I want to avoid human biases as much as possible. And this time is no different. I created code that can backtest the mentioned strategy and has also the added benefit of being usable for a trading bot for automatic trading. Now you can download this code from my Patreon site together with all the backtesting results and a full report of the strategy's performance. This way you can verify my results and also can do these tests on your own environments as well. But what about the results of this trading strategy? Well, I tested this with only long trades and doing long and short trading in futures trading. And in both of these cases, the 1 day time frame seems to have the most probability to make money with this strategy. Overall, these numbers appear to look pretty comparable if you take into account the fact that going long and shorts produces almost 70% more trades. Now please remember that in this strategy you are just entering the trade based on the candle color and its position in relation to the EMA 50, so you should expect a certain amount of randomness here. And when doing only long trades, you can see here on the equity curve that the profits have a strong correlation with bullish market circumstances. While doing long and short trades, the curve is more jagged and is more prone to follow temporary market conditions. This is also clearly visible in the drawdown plot. If you were to follow these exact rules for futures trading, you should expect to have more drawdowns a lot of the time. While doing only long trades, this drawdown is mostly impacted by trades that occur when there are bearish circumstances. It's also interesting to see which exit signal occurs the most and provides the most profits. And in long trading only, it appears that most exit signals happen when the first red candle is lower than half of the previous green candle. Interestingly, this exit signal also produces the lowest profits. The most profits happen after the trade has been exited after having two red candles. So this might be an indication to analyze and improve on that first red candle exit. In futures trading, this is almost similar. Most exit happens after the first day of trading, when there is a candle in the opposite direction that is larger than half of the value of the previous day. But what's more interesting to see here is that the exit on the first green candle when doing a short trade makes the strategy lose money. So these trades are typically losing trades. This could be an issue to attack with when improving this strategy. One reason why this happens is that there could be a large drop in the market and then a lot of buyers happen to buy the dip. Now if we compare the performance of this strategy with some of the best tested, then we can see that for both the futures version as for the long version only, the risk-adjusted return metrics are very low. And overall they do not score the best in the total strategy league, but that was not the intention of these specific trading rules. The premise was that these entry and exit rules should act as a baseline to build further on. Now of course you can use these simple rules to trade, even manually, but only after extensive research on your behalf. And you are always welcome to adjust the entry signals to your own likings, of course. Like for example using 2 green candles or even 3 before entering a trade. And also adjust the exit signals to make the strategy perform even better, because risk management should always be your first priority here. Now adding other indicators that prevent trading in ranging markets might also be a good idea, since I suspect that this is where the most losses are made. So further investigation is really necessary. But in all cases, this was more of a demonstration of the randomness of the market and that you can even enter a trade after only one single candle in a certain direction and can have profits trading these. Now, an extensive report of the performance of this trading strategy can be downloaded from my Patreon site, together with the code of this strategy and all backtest outputs for verification. But for now, this is the end of this video. If you like the content that I make, then please click like and subscribe and give a comment if you have one, and I will see you in the next one. Goodbye!